So income, as it mentioned in that previous page, income is essentially, taxable income is income from all sources, regardless of where it's derived, unless there's an exception, a specific exception. And that means income, if you are subject to US taxation, your income worldwide is subject to US taxation. So you're living in the US and you got a rental property over in Italy, lucky you, that you earn income on, that you have to declare that on your US income tax return. Okay, so worldwide income, unless it's specifically excluded, right? Now, when and how do we record this income when it comes in? So we use the accrual method of accounting for financial accounting, right? Where we have to recognize revenue when it's earned, and we recognize expenses when they're incurred, right? So it doesn't follow the cash. In tax, however, it usually follows the cash. There are a couple of exceptions to it, but for the most part, for individuals, it follows the cash. Now, for corporations, there are some different rules, and we'll talk about those at the end of the semester when we get to chapter 15. For income purposes, for tax purposes, for financial statement purposes, they talk about that it's when it's realized and when it's earned is when you record that income. Realization is when non-cash resources are converted into cash. And that's when a company or person exchanges non-cash asset or resource, maybe it's a service, maybe it's a product, in exchange for cash or a receivable in a transaction with a third party. So when there's some promise to pay, right? So most common example, selling inventory for cash or for an accounts receivable. That realization applies also to professional services, so you're exchanging knowledge for cash, asset sales, exchanging a building for cash, or a right to cash, licensing a patent, etc., etc. So in financial accounting, that income is earned when the company or person has performed all actions necessary to complete the transaction. So for tax purposes, however, our income recognition rules are a little bit different. There are three things that have to happen in order for it to be recognized as income. One, there has to be an economic benefit, and all of these conditions have to be met. So there has to be an economic benefit. If the person is economically better off because of a transaction, the person normally must record income. That's one of the conditions. All three of these have to be met. So if someone works for an employer and receives cash for the work, the person has income. They're economically better off. Person sells a car to a friend for a note receivable, the person has income. So the benefit also can be indirect, so not necessarily in cash. So if an accountant performs tax work for a client, the client agrees to pay a $500 debt that the accountant owes, they're considered to be economically better off because now they don't have the debt to pay any longer. Okay? So economically, there's got to be an economic benefit. Is it income? 2, transaction must have actually reached a conclusion. So the transaction has to occur, first off, and then it has to be completed. Now this is interesting. I'm going to talk about some current events here as related to this particular requirement. Simply owning an asset that has increased in in value does not create income. Even though there may be an economic benefit to that, you got an asset that's increased in value. For example, if an individual owns 100 shares of IBM common stock, the stock increases in price by $1 per share. No income results because no transaction has occurred. They haven't completed the transaction. Second factor, the transaction process must be complete. Often a time gap occurs between the agreement to enter into a transaction and the completion of the transaction. The completion date is the date when income is recognized. Okay, so there's a proposal out there by one particular candidate to tax unrecognized capital gains. So you hold a stock, you buy a stock for $100, you sell it, well, it goes up in value to $200, but you haven't sold it. You now owe tax on the gain, even though you haven't completed the transaction. Now, this is a proposal that is supposedly to apply only to people who are extremely wealthy. Of course, that would have economic detriments downstream from that. But aside from that, it cannot be considered income because it doesn't meet the definition of income that is in the tax code. That can't be an income tax because there is no income. The income hasn't been recognized yet because the transaction hasn't concluded at that point. Okay, so it's just kind of an interesting, I don't know what the proposal is as far as how it would be classified, but it can't be classified as income because it doesn't meet the basic definition of what income is when it's recognized within the tax code. So, transaction has to conclude. And then, the last condition, the income cannot be tax exempt. So like I said, everything is income unless they say it's not. So if they say it's not income or taxable income, then it's tax exempt. So this is essentially our income for tax purposes. There has to be some sort of economic benefit, transaction has to have concluded, and the income can't be tax exempt. So this transaction has concluded also is very different from financial accounting, because in financial accounting you can have receivables on the books. That transaction hasn't concluded, you haven't collected the money yet. However, it's considered as revenue for financial accounting purposes, right? But for tax purposes, it would not be considered as income. So you've got this difference between what's on your books and what's on your tax return. This is a difference we're going to come back to when we start talking about corporate taxation, because this is a big deal with preparing corporate tax returns. Don't worry, you're not going to prepare a corporate tax return. But this is a big part of that preparation process, is connecting these two, the financial accounting records to the tax return, and essentially reconciling those two. So we've got here, Raul agreed to repair a damaged roof and started to work on that date. December 22nd, so end of the year. January 6th, he completed the job and received payment. When do we record his income? We don't do it in 2022 because it hasn't completed yet. Hasn't even occurred yet, really, right? In 2023, though, he completes it and he gets paid for it. So we're going to record it in 2023. Okay? So those are the three conditions. Questions about those? I mean, it's pretty simple, but it's way different from the income recognition for financial accounting purposes. Questions?